800, that is my FICO credit score. It's actually a bit down from its peak of 820 something because I've been testing out some new credit cards and loan stuff for you guys. Your FICO credit score is actually what 90% of lenders think banks and credit card companies. 90% of them use your FICO score to decide whether or not to approve you for a credit card or loan. And generally, the better your FICO credit score, the lower your interest rate will be. And the less you'll need to shell out to your lenders in the long run. Which means the smaller the hole will be that you have to dig yourself out of, and the quicker you can kickstart your debt-free millionaire journey. Speaking of which, I'll be digging myself out of a pretty big hole after I'm done here. Welcome to what's happening outside, our fourth winter storm of the season. So what can you do to improve your credit score so that it also looks like this? Pay your debt on time every month. Keep your credit utilization below 30%. Don't close your old accounts. Don't open new accounts either, at least not more often than every 3 months. And improve your credit mix. By the end of this video, all 5 of these things will be clear to you, and you'll know exactly how to improve your credit score and lower your interest rate in 2022 on your credit cards and your loans. Hey future millionaire, it's Jennifer Diamond NestEgg, where we talk all about money and your millionaire journey. Build your wealth, protect your wealth. This table here shows you what FICO considers as an excellent, very good, good, and all the way down to poor credit score. Any score in the very good range or above should be your target. Because your FICO score is what most lenders use, let's look specifically at the 5 factors that impact your FICO score. Just know that whatever you do to improve your FICO score will also have a similar impact on your credit score with Vantage, Equifax, Experian, and TransUnion. You'll see from this illustration that the 2 biggest factors are 1, your payment history, and 2, the amounts owed. I've circled these in yellow. Your payment history and amounts owed together make up 65% of your FICO credit score calculation. Payment history refers to whether you make your payments on time. Your credit score experiences double-digit drops when you pay any credit card or loan more than 30 days after the due date. Your score drops further if you pay 60 or 90 days late. So yeah, please try to avoid that at all costs. Amounts owed refers to how much of your credit limit you've used. It's also known as credit utilization. The gold standard for credit utilization is 30%. So, if you want your credit score to go up, keep your balances under 30% of your credit limit. This means that if your total credit limit is $10,000, you should never have more than a balance of $3,000 on it. If your credit utilization exceeds 30% of your credit limit, your credit score will drop for sure. Even if you do nothing else, you'll improve your credit score by simply making your payments on time and keeping your credit utilization to under 30%. Factor 3 impacting your FICO score is the length of credit history. The length of your credit history makes up 15% of your credit score and refers to the average amount of time the accounts on your credit report have been open. It does not take into consideration any accounts that are closed or not listed on your credit report. All things being equal, the longer your credit history, the higher your credit score. So, if you're not an overspender and tempted by credit cards in your wallet or lying around the house, don't close your old credit cards. Here's what we have so far. Your payment history, paying on time. Your amounts owed, keeping your credit utilization below 30%. And the length of your credit history, not closing old accounts. Doing just these 3 things already puts you ahead of the game when it comes to keeping your FICO score up, because these 3 factors combined make up 80% of your credit score. So, future millionaire, if you like the top credit tips you've seen so far, I'd really appreciate it if you give that thumbs up and subscribe, a gentle tap. This will get the video out there to others like you looking to improve their credit score and lower the interest rate on their debt. And if you're serious about giving your millionaire journey the boost it deserves, Serious about improving your credit and paying down debt? Then drop me a note at jennifer@diamondnestegg.com about one-on-one financial coaching, or join me in our newly reopened Millionaire Masters course so that you can do this faster than you would be able to on your own. I've included your YouTube discount code for Millionaire Masters below this video. Moving on to factor 4 impacting your FICO score: new credit. New credit makes up 10% of your credit score. New credit refers to the amount of new accounts you've opened or tried to open recently. Anytime you submit an application for a new loan or credit card, the bank runs what's called a hard inquiry on you, meaning they check your credit history and scores to make sure that you're trustworthy and will pay them back what you borrow in a timely manner. If you have a good credit history, your credit score may temporarily drop a few points on average, and only for a very short period of time. If your credit history is not so stellar, it may have a bigger impact. If you're looking to increase your credit score, make sure you keep those hard inquiries to a minimum. Too many hard inquiries over a short period of time is a cause of concern for lenders. Lenders worry when you try to open too many accounts over a short time span because they start wondering why you suddenly need to borrow so much money and whether you'll be able to pay everything back. Generally speaking, you shouldn't have more than one hard inquiry every 3 months. This is especially true if you're applying for a new mortgage or home equity line of credit, or looking to refinance an existing one. You'll always know when there's a hard inquiry on your credit report because your lender, employer, or landlord will ask you to sign a document allowing them to run this search. They can't do it without your signature, your written permission. That's a hard inquiry. A soft inquiry is when you go on Credit Karma, Mint, or one of those other personal finance apps to check your score. This you can do as often as you want, and it will have no impact whatsoever on your credit score. If you're not sure what your credit report or credit score looks like, then it's time to take a look at our credit and paying off debt videos here. You should be checking your credit report at least once a year, and it's free to do. And your credit score, you should be checking that even more often. Moving on to the 5th factor impacting your FICO score, and that's your credit mix. Credit mix makes up the last 10% of your credit score. Credit mix refers to the different types of credit cards and loans you have, such as personal loans, student loans, car loans, boat loans, and mortgages. Your lenders like knowing that you can handle different types of debt products well. So, for example, if you just have student loans, you could try to open up a new credit card. Or if you only have credit card debt, you could try to take out an installment loan, such as a car loan or personal loan. In fact, in this case, one smart way to improve your credit mix, to improve your credit score, and lower your interest rate at the same time is to consolidate some of your higher interest credit card debt via a lower interest personal loan. You can learn more about this via our debt consolidation video here, where I review the 2 lenders we use most often, SoFi and Payoff. Or drop me a note at jennifer@diamondnestegg.com for one-on-one support to speed up your debt-free millionaire journey. Thanks for watching, guys. If you enjoyed this video, don't forget to like and subscribe. I'll be back next week with another money-saving, wealth-building video for you, future millionaire.